For years, mediocre fund managers and founders operated within a forgiving system. Abundant liquidity and dirt-cheap debt provided a thick layer of insulation that masked broken business models and poor execution. By 2026, that insulation has stripped away. While capital is still present in the system, it has become violently selective about where it settles. The current environment is actively stress-testing over-leveraged portfolios. Any strategy that relied on the clever movement of numbers rather than the growth of the underlying business is now completely exposed. Founders are finding that aggressive leverage has transformed from a growth tool into a lethal liability. Lenders are no longer interested in potential, they are demanding proof of stability. This forces a precise load-bearing calculation. You have to determine exactly how much weight your revenue can support before the underlying debt covenants crush your ability to operate. In this market, capitalization functions as a survival mechanism. If the structural math is off by even a fraction, the business risks total collapse. Accepting the highest headline valuation from a partner often feels like a win. In reality, it is frequently the first step toward losing control of the company. High entry multiples hide heavy weights, restrictive rights, and liquidation preferences prioritizing investor payouts. These rigid debt covenants drain internal resources, consuming the operating cash flow needed to survive. Diverting cash to service debt leaves zero room for error. Development stalls and acquisition capital vanishes. Leverage only works when it amplifies a proven high-margin cash engine. Using it to bridge the gap in a broken model only accelerates the failure. Since the market will no longer inflate your exit price for you, any increase in value must be engineered from the inside out. You can no longer rely on the next buyer to pay a higher multiple just because time has passed. You have to prove the business is more efficient than it was on day one. This means professionalizing internal reporting, eliminating financial blind spots, and diversifying your client base to remove customer concentration. True value is built by optimizing sales conversion loops and using targeted automation to physically expand your margins. Private equity investors look for a specific foundational support before they commit: a heavy management rollover. If the leadership team isn't willing to keep their own equity locked in the deal, it signals to the market that they don't believe in their own ability to execute the plan. Success depends on complete transparency. If the incentives between founders and investors aren't perfectly aligned, the structure will buckle the moment the market shifts. A private equity investment comes with a preset expiration date. The clock is running on a fixed timeline toward liquidity. This timeline is driven by external pressure. The funds providing the capital are obligated to distribute returns back to their limited partners on a rigid schedule. Because the deadline is fixed, the exit strategy must be engineered before the initial transaction is even finalized. Leaving the exit to chance is a failure of design. You need clean financials, bulletproof cybersecurity, and a verified universe of secondary buyers ready long before the clock runs out. Without this infrastructure, the capitalization structure stalls, leaving the company trapped in a position where it can neither grow nor sell. Treat your capitalization as strategic infrastructure. Build a foundation that can withstand the pressure, or the market will dismantle the business for you.